Hey everyone, welcome back to Wealth for You, the channel where we break down investing in Singapore in plain, simple English. Now listen up. Today we're diving into one of the biggest players in the REIT world, CapitaLand Ascendas REIT. They just dropped their first half 2025 results on 4th August, and just a few weeks later announced a massive 329 million Singapore dollars sale of 5 properties right here in Singapore. Here's the big question. Is Ascendas REIT still a solid buy for dividend investors like us? Or is it time to just hold? Stick with me till the very end, because we're going to cover their latest financial results, the juicy details behind this property divestment, whether Ascendas is undervalued or overpriced at today's share price, and most importantly, what this means for your dividends going forward. So smash that like button so more Singaporeans can learn about REIT investing, and hit subscribe to Wealth for You if you want more clear, no-nonsense breakdowns like this every week. Quick disclaimer before we jump in. This video is for educational purposes only. I'm not a financial advisor, so always do your own research or speak with a licensed professional before making any investment decisions. Chapter 1. What are REITs? The basics explained. First things first, let's rewind. If you're new to this, a REIT is a real estate investment trust. Think of it like a group buy for properties. Instead of you and me buying one office building, which is, a tad expensive, a REIT pools money from thousands of investors and owns a huge portfolio of real estate. The REIT then rents out these properties, collects income, and, here's the fun part, they're required to pay out at least 90% of taxable income back to us investors as dividends. Nice steady cash flow, which is why Singaporeans love REITs. Chapter 2. Ascendas REIT. The basics. All right, let's get to know the star of today's story. CapitaLand Ascendas REIT, or CLAR. Fun fact. It isn't just another REIT on the SGX. It was actually Singapore's very first listed business space and industrial REIT, debuting way back in November 2002. From that humble start, CLAR has grown into a true heavyweight. As of June 2025, its portfolio spans about 225 properties across Singapore, Australia, the US, and Europe. With the latest acquisition and a few divestments in the pipeline, that number will hover around 226 properties soon. Either way, it's massive. All those properties combined are valued at roughly $16.8 billion. Think about that for a second. $16.8 billion worth of office parks, logistics hubs, and high-tech spaces. And it's not just size, it's quality too. Portfolio occupancy stands at 91.8%, which means nearly every property is pulling in rent. Even better, in the first half of 2025, CLAR achieved plus 9.5% rental reversion. Translation: when tenants renewed their leases, on average they agreed to pay nearly 10% more rent. That's like your landlord asking for higher rent, and you saying, sure, definitely a sign that demand for CLAR's properties is strong. Chapter 3. 1H 2025. Financial results. Stability amidst change. All right, let's dive into the numbers. For the first half of 2025 ended on 30th of June 2025, Ascendas REIT saw its gross revenue come in at about $754.8 million, which was a slight dip of 2% compared to the same period last year. Net property income also edged down, falling 0.9% to $523.4 million. But here's the part that matters most to dividend investors. Distributable income held steady at $331.1 million, essentially flat year-on-year. And while the distribution per unit eased just a touch, slipping 0.6% to 7.47 cents, the key message is this. Even with a small decline at the top line, Ascendas managed to protect its payout. For income investors, that stability is the real win. Chapter 4. Valuation check. Overpriced or undervalued? Let's take a closer look at valuation, because this is where numbers can get a little tricky. CapitaLand Ascendas REIT's market capitalization is about 12.3 billion Singapore dollars, based on its current unit price and total units in issue. That's the figure investors should focus on when judging how the market values CLAR today. In terms of ratios, the price-to-book stands at roughly 1.2 times. This means the REIT trades at a premium to its book value, reflecting investor confidence in its portfolio strength and management. The gearing ratio is 37.4%, comfortably below the regulatory 50% ceiling, so its balance sheet is in good health. Meanwhile, the price-to-earnings ratio is closer to 17 times, which is on the higher side compared to some peers, though not unreasonable given its scale and diversification. So, what's the bottom line? CLAR is not undervalued. It's trading at a slight premium, which signals stability and quality. For investors, this means it's a safe and resilient choice, but it's not exactly a bargain at current prices. Chapter 5. Dividend History and Yield. The payout story. Now, let's talk about the part every dividend investor cares about the most: the payouts. CapitaLand Ascendas REIT has built a solid track record of rewarding unit holders with steady dividends ever since it first listed back in 2002. That's more than 2 decades of consistent distributions through market cycles, financial crises, and even the pandemic. For many long-term investors, this history itself is a mark of reliability. Looking at the numbers, the trailing 12-month dividend yield sits at about 5.3%, and based on management's guidance, the forward yield is expected to be around 5.4%. That's a respectable level, especially for a large-cap REIT with a diversified portfolio like CLAR's. But here's what makes it even more reassuring. These dividends are funded primarily by recurring rental income from tenants across its business parks, logistics hubs, and data centers, not from one-off property sales or financial engineering. In other words, the cash flow that unit holders receive is tied to the everyday operations of the REIT, making it far more sustainable. Management has also been consistent in its messaging. The focus is on delivering stable, recurring payouts backed by operations, not on boosting distributions artificially with capital gains. That gives investors greater confidence that the dividends they receive are not just attractive today, but can also hold up well into the future. Chapter 6. The Big News. Divestment of 5 properties. Now let's talk about the headline that's been making waves. Ascendas REIT's decision to divest 5 Singapore industrial and logistics properties for a total of 329 million Singapore dollars. The properties are 31 Ubi Road 1, 9 Changi South Street, 3, 10 Toh Guan Road, 19 and 21 Pandan Avenue, and 31 Tampines Industrial Avenue 3. Why did management decide to sell? It comes down to 2 main reasons. First, these assets had a very short WALE, or weighted average lease expiry, of just 1.6 years. In plain English, the rental streams weren't secure. Tenants could walk away or renegotiate in the near term, which weakens income stability. Second, the land tenure on these properties averaged only 27 years. In Singapore, that's a big red flag. Properties with short leases steadily lose value as the lease burns down, and they also become harder to attract tenants at good rates. By selling now, Ascendas has been able to lock in strong gains for unit holders. The sale was 6% above the latest market valuation, around 20% above the original purchase cost, and will deliver about 313 million Singapore dollars in net proceeds after costs. Now, let's address the nuance. The Toh Guan Road property was sold below its original purchase price, about an 8% discount. But importantly, it was still transacted at a 6% premium to its current valuation. So while on paper it looks like a loss compared to the historical purchase, in reality, the overall portfolio divestment remains clearly accretive. So what does this mean for unit holders? In the short term, there may be a slight dip in DPU because those properties were income generating and the proceeds haven't yet been redeployed. But management has been upfront about this, and it's normal in the capital recycling process. The long-term benefits, however, are the real story. By pruning older assets with short leases and limited land tenure, Claire is freeing up capital to reinvest in new economy sectors like data centers, logistics hubs, and life sciences parks. These are future-proof, higher-quality assets with stronger tenant demand and longer lease terms. In short, this is a classic case of trading near-term stability for long-term resilience and growth. For income investors, that's ultimately beneficial, because it helps protect distributions from eroding as weaker assets age and lose value. Chapter 7. Critical Evaluation. The Big Picture. So how do we rate this? Let's break it down. From a financial performance perspective, Ascendas' first half of 2025 was stable, but not exactly exciting. DPU slipped marginally, a mere 0.6%, which for income investors is noticeable but not alarming. The silver lining is in the portfolio metrics, where we saw a healthy plus 9.5% rental reversion. That tells us tenants are willing to pay more for Claire's spaces, and in today's market, that is a strong signal of pricing power. Now, the divestment decision. This is where management earns their stripes. Selling off older, short-tenure properties with weak leases isn't just housekeeping, it's strategic foresight. These assets would have become a drag on long-term growth if left untouched. By cashing out now, Claire crystallized gains and freed up more than 300 million Singapore dollars in fresh capital. And importantly, this isn't money that's going to sit idle. The proceeds are being redirected into higher-quality, future-ready assets. Think UK logistics hubs, freehold, green-certified, and positioned right where the e-commerce boom continues to accelerate. Singapore data centers and life sciences parks, sectors with structural tailwinds, longer WALEs, and higher tenant stickiness. So yes, let's be clear. In the short term, unit holders may feel a tiny pinch in DPU while these funds are being redeployed. But if you zoom out, this is exactly how a REIT stays competitive. By constantly refreshing its portfolio and pivoting into the new economy sectors that will drive demand for the next decade. The way I see it, this isn't just about protecting distributions today. It's about future-proofing Ascendas REIT so that income investors like us don't wake up one day holding a stale portfolio of declining industrial sheds. Management is playing the long game, and in the world of REIT investing, that's what separates the winners from the rest. Chapter 8. The Future Outlook. What's next for Ascendas REIT? And here's the juicy part. The road ahead looks promising for both Ascendas REIT and the broader REIT sector. With global central banks expected to start cutting interest rates in 2025 and 2026, REITs stand to gain in two very tangible ways. First, lower borrowing costs directly reduce financing expenses. For a giant like Ascendas, where debt runs into billions, even a 50 to 100 basis point cut can free up millions in savings each year. That's money that flows straight back into net property income and ultimately into higher distributions per unit for unit holders. Second, as bond yields fall, income investors will once again turn to REITs as an attractive alternative, supporting demand for units and stabilizing valuations. But what really excites me is how Ascendas is repositioning its portfolio for the next decade of growth. This isn't just about holding on to old industrial sheds and hoping for the best. The REIT is deliberately pivoting into logistics hubs, data centers, and life sciences parks, all sectors backed by powerful structural trends. E-commerce growth continues to fuel demand for logistics warehouses across Europe and beyond. Digitalization and cloud adoption are driving an insatiable need for data centers, especially in Singapore where supply is scarce and pricing power is strong. Life sciences and biotech research are expanding rapidly in Asia, and dedicated R&D spaces command premium rents with sticky long-term tenants. Combine this with Ascendas' already solid financial footing, a healthy gearing ratio and strong rental reversions, and you've got a REIT that's not just resilient in the short term, but future-proofed for the long haul. So when you put it all together, lower interest rates, stronger income visibility, and a forward-looking asset mix, the picture is clear. Ascendas isn't just surviving this economic cycle, it's positioning itself to thrive in the next one. Final thoughts. Buy or hold? So, is Ascendas REIT a buy? Let's wrap this up. For income investors, yes. With a dividend yield of around 5.3%, backed by recurring rental income, it remains one of the most reliable payout machines on the SGX. For long-term growth seekers, also yes. The REIT is recycling into logistics, data centers, and life sciences, future-proof sectors with strong demand. In the short term, be prepared for dividends to stay flat or even dip slightly as proceeds from divestments are redeployed into new assets. Overall, if you're already holding, it's a solid hold. If you're looking to start, it's a reasonable buy, provided you're patient and focused on the bigger picture. Remember, REIT investing is a marathon, not a sprint. The winners are those who collect dividends consistently, year after year. And here's the mindset shift I always stress. It's not about being paper asset rich, it's about being cash flow rich. Because at the end of the day, it's your dividend payouts, not just your unit price, that pay for your lifestyle. So that's the breakdown of Ascendas REIT's results and the big $329 million property sale. What do you think? Is Ascendas still a must-have in every Singapore dividend investor's portfolio? Let me know in the comments below. If you found this breakdown useful, do me a favor. Hit the like button so more Singaporeans can learn about dividend investing. And don't forget to subscribe to Wealth for You and tap the notification bell so you'll never miss updates on REITs, banks, and passive income strategies in Singapore. Till next time, happy investing, stay focused, and always aim to be cash flow rich, not just paper rich. Huat ah.